Dividend stocks with fat yields are compelling investments for investors seeking regular income. Beyond just receiving steady payouts, reinvesting these dividends can significantly grow your holdings and enhance your overall returns. However, it's important to focus on companies known for their consistent payments and a history of increasing dividends. The high yield and resilient payouts of these stocks make them appealing, especially in times of economic uncertainty or when interest rates decline. Are you investing for long-term income and financial freedom? Subscribe now because I'm here every week sharing the best stocks to help grow your wealth. Among the top dividend stocks, Enterprise Products Partners, Altria, and Realty Income appear attractive. These companies have fat yields of over 5%. Further, these companies have consistently paid and increased their dividends for years. This reflects the sustainability of their payouts, making them solid choices for generating a steady income. Enterprise Products Partners, ticker symbol EPD, is a leading North American provider of midstream energy services. The company operates an extensive network of pipelines, storage facilities, and processing plants that transport and store natural gas, crude oil, and refined products. EPD's integrated system allows it to offer a wide range of services to its customers, including natural gas gathering, processing, and transportation, as well as crude oil and refined products transportation and storage. One of the key strengths of Enterprise Products Partners is its stable cash flow, which is supported by long-term contracts with credit-worthy customers. This stability allows the company to pay a generous dividend to its shareholders. As of now, EPD offers a dividend yield of over 7%, making it an attractive option for income-focused investors. The company has a strong track record of increasing its dividend, having done so for over 20 consecutive years. In addition to its impressive dividend yield, Enterprise Products Partners is well positioned to benefit from the growing demand for energy infrastructure in North America. The company continues to invest in new projects and expand its existing assets to meet the needs of its customers. With a strong balance sheet and a commitment to disciplined capital allocation, EPD is poised for long-term growth and value creation for its shareholders. Overall, Enterprise Products Partners stands out as a reliable dividend stock with a high yield and a solid growth outlook. For investors seeking a combination of income and growth potential, EPD is a compelling choice. The company specializes in midstream energy services and offers gathering, transportation, and processing of crude oil, natural gas, and natural gas liquids. The company's energy infrastructure assets witness solid demand. Moreover, about 90% of its long-term contracts include provisions that safeguard against inflation, ensuring stable cash flow and consistent distribution growth. Enterprise Products has consistently rewarded its shareholders by increasing its dividend for more than 25 years. In 2024 alone, the company distributed approximately $4.6 billion to investors, marking a total return of $56 billion since its IPO in 1998 through distributions and buybacks. Looking forward, Enterprise Products remains focused on enhancing cash flow per unit and expanding its midstream energy infrastructure, including recent acquisitions and new processing plants. These strategic moves are poised to bolster future dividend payouts. Further, Enterprise Products is well positioned for continued growth with a strong balance sheet and solid liquidity. Wall Street recommends a moderate buy on Enterprise Products stock. It offers a forward yield of 6.4%. Let's take a closer look at Altria, often recognized by its ticker symbol, MO. This company is well regarded in the dividend stock arena for its consistent high-yield returns. Altria has a long history of providing substantial dividends to its shareholders, making it a favorite among income-focused investors. The company primarily operates in the tobacco industry, with its flagship brand being Marlboro. However, Altria has diversified its portfolio over the years to include smokeless tobacco products, wine, and even cannabis investments. This diversification strategy has helped Altria maintain its strong dividend payouts despite the declining cigarette market. Financial analysts often highlight Altria's robust dividend history and its commitment to returning value to shareholders. The company's stock performance has been relatively stable, and its dividend yield remains attractive, especially in today's low-interest rate environment. For those seeking reliable income, Altria continues to be a compelling choice. Altria is a reliable, high-yield dividend stock. The tobacco giant continues to reward shareholders with higher dividends and share buybacks. Moreover, it continues to pursue growth opportunities which will drive its future payouts. Altria's payouts are supported by the strength in its core smokable products segment, which consistently delivers strong operating income growth. Meanwhile, its oral tobacco segment, particularly its moist smokeless tobacco brands, remains a steady source of profitability. Together, these divisions provide the foundation for Altria's ability to pay and raise dividends. It has a history of generous dividend increases. Altria announced a 4.1% dividend increase last year, marking its 59th hike in the past 55 years. Further, it projects mid-single-digit annual dividend growth through 2028. Altria is well-positioned for future growth. It plans to double its U.S. smoke-free product revenue from $2 billion in 2022 to $5 billion by 2028. This expansion into high-margin smoke-free products will significantly boost its earnings. Further, its focus on streamlining operations and reducing costs will enable it to maximize shareholder value. While Wall Street analysts rate Altria as a hold, its 7.6% dividend yield and visibility over future dividend growth make it an attractive option for income investors. Realty Income, often referred to as the monthly dividend company, is a real estate investment trust, REIT, that has been a reliable source of income for investors. With a portfolio of over 6,500 properties, Realty Income focuses on commercial real estate leased to tenants under long-term agreements. The company is known for its consistent monthly dividend payments, which have been increased over 100 times since its public listing in 1994. Realty Income's tenants include well-known names like Walgreens, 7-Eleven, and FedEx, providing a stable and diversified income stream. The company's business model is built on acquiring and managing properties that generate predictable cash flow, making it a favorite among income-focused investors. Realty Income stock offers a dividend yield of over 5%, making it an attractive option for those seeking regular income. The company's strong financials and commitment to shareholder returns have made it a cornerstone in many dividend portfolios. With a proven track record of performance and a focus on high-quality properties, Realty Income continues to be a top choice for dividend investors. Realty Income, famously known as the monthly dividend company, is a top bet for generating worry-free income. The Real Estate Investment Trust, or REIT, is a dividend aristocrat and pays a monthly dividend of $0.264 per share. Thanks to its resilient real estate portfolio and high occupancy rate, Realty Income has raised its dividend 126 times in the past 30 years. Moreover, the REIT increased its dividend at a compound annual growth rate of 4.3% during this period. Realty Income's payouts are supported by the company's extensive portfolio of 15,457 real estate properties, which generate strong and stable cash flows. Additionally, the majority of these properties are secured under long-term net lease agreements, providing predictable revenue streams and enhancing financial stability. Realty Income's commercial real estate holdings are well diversified, ensuring consistent income generation. Notably, 90% of its rental revenue is either resilient to economic downturns or insulated from disruptions caused by e-commerce trends. The company maintains a high occupancy rate of 98.7% and continues to expand internationally, which will support its future payouts. The stock has a moderate buy consensus rating and a compelling forward yield of 5.7%. If you got value from these dividend stock picks, give this video a thumbs up and subscribe for more. And don't stop here. Check out these other videos for even more ways to grow your passive income portfolio. If you got value from these dividend stock picks, give this video a thumbs up and subscribe for more. And don't stop here. Check out these other videos for even more ways to grow your passive income portfolio.